Hi guys, this is one of our few updates we're going to be bringing out to you regarding one of our trading strategies. I'm just going to go through in a bit more depth the strategy we put out there yesterday, just to give you a bit more clarification on what to look for and how to best use this strategy for your trading. What I've got in front of me here is the New Zealand dollar pair. Top left hand corner, you can see that. So looking at this pair on a day view, we can see, looking from the left, pair broke down, had a rally. It's obviously couldn't break this top, so it fell back down again. Another small rally up and a further breakdown. And now we see this rally. Now, using our strategy, this could potentially be a rally to the upside, and we could be looking for the market to return to around here. Well, how do we know that, and how can we put a bit more confirmation into the direction of this trade? Well, a simple way is we can put a Fibonacci retracement, swing high to swing low, and that will give us the key three levels. We can see the market is hitting our 61.8 level here, and if we zoom in on our hour chart, we can see that level up here. But we'll come back to that in a moment. If we go back to the very start of the strategy, like we showed in our previous video, what we like to do is on a Friday here, we've marked off our previous day's high, okay, and previous day's low. And then the following day, on the Monday, as you can see, we're looking for a break of this level, a retracement to the level, and then a continued move up. And remember, this strategy is for 30 pips. So if we look here where the breakthrough, and we would say to enter the trade here, our 30 pips, we've comfortably got the 30 pips in the day. And there's our 20 to 30 pips, nice, easy profit. Like we said before, you would always put your key stop loss at the last swing low, which I've marked off here. So at no point, if we look, as the market was going up, we came near our swing low or our stop loss. Now, you could have left this trade, just bring your stop loss up to the next swing low for that day and just follow the market up. Well, if we do that, we can see that the market came all the way up. We put our previous day high on and our previous day low. This is where our new stop loss would be, and we can see again the market came nowhere near it. The next day we've put our previous day high on, previous day low, and the market just ranged. It broke out slightly, pulled back, but we wouldn't have hit any of the stop loss areas. So a good trading strategy if we adhere to those rules. Now, like we looked at before, we've put in our Fibonacci from the swing high to the swing low to identify if this market is going to go higher. We can see this fib level is pretty much on a key consolidation area here. The market bounced off it here nicely, and here we go, the market has bounced off and rejected. Now here's our previous day's high, our previous day low, so we can see the market is bouncing in a sideways area, maybe consolidating before a move to the upside, who knows. But sticking with our trading strategy, there's no trade today because we've had no clear breakout and close below or above. So it's a case of just sitting back on this trade and waiting for a good breakout, retracement, and a continuation to the downside, or a move up, breaks through this key fib, breaks through the previous day's high, retraces, and a move to the upside. We've also got to be aware of our 200, 100 day moving averages and our 14 and 21 day moving averages. Where we see them slightly open here, the market looks to be still going to the upside. But if we start seeing these moving averages converge and cross over, then we could see a change in direction. So at the moment on this trade, New Zealand against the dollar, we're in consolidation sideways market. We're just waiting for confirmation of a break to the upside or to the downside. Moving on, we've got the Swiss franc yen. Now this is a good little exercise on where it can go wrong on this trading strategy, and where you could get in on a good entry. So if we look again, we've got Monday, Friday, Thursday, Wednesday, Tuesday, Monday. So this is Friday. Here's our previous day's high marked off and previous day's low. We can see the market hit our high, bounce down, okay, hit it again, bounce down. It broke through, closed, pulled back nicely, so we could have put a buy in at this level with our stop loss here, okay, and then we would have easily got our 30 pips. Now if you'd have left the trade and moved the stop loss up to each previous day's low, you would still be in this trade, okay, even though it came down here, we're still above the previous day's low. Now this is the interesting thing about this trade, is we can start seeing a double top forming and nothing has broken above this key high. They're pretty much the same, and it looks like it's slowly moving sideways. Now on this day, on the Friday, we can see we broke through the previous day's low. We had our retracement and then a further move to the downside. So you would be in a good short sell here because there was no indication to the upside, there was clear indication to the downside. Now Monday here, we've got a slight sideways market, but we did have a break, a retrace through, another break, okay, and a retrace through. And we would have been sellers here, okay, and we'd be in the market now on a sell. Bearing in mind our key stop loss is right the way up here, so we're nearly, I'd say, 60-40 away from our stop loss. Now what I find interesting on this trade is it looks like the market is turning, and if we just put this level in, marked off the previous day's low here, which the market broke through, we can see the market has respected this level, and we could see this as the turning point for a continuation to the downside. So if you were taking this as a 50-50 risk, this area here is your 50-50 risk on shorting the market. And you can see now it's 5:10. What we're going to do is we're going to mark this area off, okay, as our good entry, okay, and tomorrow when we do our next update, we can see if this was a good entry to continue the short. Our stop loss is obviously up here on previous day's high. So if we're getting into the market here, we're risking 24-25 pips. But if we continue to the downside, we're looking at 40 pips for continuation of the breakthrough. So, you know, it's a good risk reward. If you go in a small position, if you break through here, then add on to it. If it continues up, then we can just look at this as a deviation to the upside. So yes, there is a lot of risk on this trade, but I don't know. I think it could be a small retracement prior to a continued downside momentum. So we'll update you tomorrow on this trade, as well as the New Zealand dollar. Again, we'll keep an eye on this, see what happens, see if we get the breakout. to the downside or continued move to the upside. Hopefully that's given you a bit more insight into this trade strategy, and over the next coming days, week, whilst we take you through it step by step, this can aid in your trading decision. Any questions or comments, just let us know.